What if I told you that the single most important skill for a profitable trader has nothing to do with finding the perfect entry, nothing to do with a secret indicator, and everything to do with one thing: survival? Welcome, traders. Today we're not talking about how to make money. We're talking about how to keep it. This is a full masterclass on the one thing that separates the pros from the amateurs: rock-solid risk management. We will build your complete risk management framework from the ground up. Stick around, because this might just be the most valuable time you ever spend on your trading journey. Chapter 1. The Foundation, the 1% Rule, and why it's non-negotiable. Let's start with the bedrock of all risk management, the 1% Rule. This is not a suggestion, it's a rule, and it's simple. You should never, ever risk more than 1% of your total trading capital on a single trade. Why? Let's do the math. If you have a $10,000 account, 1% is $100. That $100 is your maximum allowed loss per trade, not what you think you'll make, but what you are willing to lose. The power of this rule isn't about the losses, it's about the downside sequence. If you risk 5% per trade, and you have a perfectly normal string of 5 losing trades, which happens to everyone, you're down 25% of your account. You now need to make back 33% just to break even. That's a huge mountain to climb. But if you risk 1%, that same 5-loss streak only puts you down 5%. You can recover from that with your next good trade. The 1% rule is your shield against the inevitable losing streaks. It keeps you in the game. Your first homework: write this down. I will not risk more than 1% of my account on any single trade. This is your new law. Chapter 2. The Trinity of a trade: position sizing, stop loss, and R multiples. The 1% rule is useless if you don't know how to apply it. This is where the holy trinity of a trade comes in. These 3 elements are calculated together before you ever click the buy button. Step 1. Find your stop loss. Your stop loss is not a failure. It's a pre-planned exit strategy. You determine your stop loss based on your strategy's logic. Below support, above resistance, based on ATR. Let's say your system says your stop loss is 50 pips, or 50 cents away from your entry. Step 2. Calculate your position size. This is the magic formula that links your 1% risk to your stop loss. The formula is position size equals account balance into risk percent divide by entry price minus stop loss price. Let's use our $10,000 account, risking 1%, $100. Our stop loss is 50 cents away. Position size equals $10,000 into 0.01 divide 50 cents equals $100 divide 50 cents equals 200 shares. That's it. You now know you can buy 200 shares. If you get stopped out, you lose exactly $100, which is your 1%. Step 3. Understand our multiples. This is how the pros measure performance. Your risk on a trade, that $100, is 1R. It's your unit of risk. Now, if your profit target is 100 cents away, that's a 2-to-1 reward to risk ratio. If you win that trade, you make $200, which is a plus 2R win. Start thinking in R. Your goal is to be a profitable trader, is to have your average win be larger than your average loss. If you consistently aim for 2R or 3R profits while only risking 1R, you can be wrong more than half the time and still be profitable. Chapter 3. The Bigger Picture, Portfolio and Correlation Risk. Okay, you've mastered the single trade, but what about multiple trades? This is where beginners blow up. They think, I'm only risking 1% per trade, but they open 5 trades all in the same sector. Folio risk. You must have a maximum daily drawdown limit. A good rule is 3 to 5%. If you hit that loss for the day, you stop trading. Walk away. Live to fight tomorrow. Correlation risk. If you have 3 long positions on Apple, Tesla, and Nvidia, you don't have 3 separate trades. You have one very large bet on the tech sector. If the sector sells off, all 3 of your 1% trades will hit their stop losses simultaneously. That's a 3% loss in minutes. The solution? Diversify your trades. Look for opportunities in different sectors, different asset classes, Forex, commodities, indices, or even different strategies, swing trades and day trades. This ensures your trades are truly independent. Chapter 4. The Trader's Mindset. Psychology of Risk. All these rules are simple math, but they are hard to execute. Why? Because of your ego and your emotions. The number 1 killer, moving your stop loss. You're in a trade, it goes against you, and it's approaching your stop. The thought creeps in. If I just move my stop a little further, it might come back. No, this is how a 1R loss turns into a 5R disaster. Your preset stop loss is a promise you make to yourself. Keep it. Revenge trading. You just took a loss, you're angry. You immediately jump into another trade to make the money back. This trade has no edge, no plan. You're just gambling. This violates every rule we've set. The solution: a trading journal. After every trade, win or lose, you write it down. Why did you take it? What was the R multiple? Did you follow your rules? This creates accountability and turns your mistakes into your best lessons. Chapter 5. Building your risk management cheat sheet. Let's bring it all together. Before you take any trade, you must run through this checklist. I want you to put this on a sticky note on your monitor. 1. Pre-trade checklist. Market analysis done. Is this trade aligned with the overall trend and my strategy? Risk percent defined. Is this 1% of my account? Maybe 0.5% if it's a shakier setup. Stop loss set. Is my SL placed logically based on the chart? Position size calculated. Did I use the formula to get the correct number of shares, units? Profit target set. Do I have a clear exit for a win, aiming for at least a 1-to-1 RR? 2. Post-trade review. Journal. The trade. Record the R multiple, the reason for entry, exit, and your emotional state. 3. Daily rules. Daily loss limit. If I hit a 3% loss today, I turn off the screens. Maximum open trades. I will not have more than 3 or more trades open at once, and they must be uncorrelated. And there you have it, a complete risk management framework. Remember, great traders aren't defined by their winning trades. They're defined by how they manage their losing ones. Risk management is not sexy. It won't make for a great Instagram post, but it is the absolute foundation of longevity and consistency in the markets. Your mission is not to become a hero on one trade. Your mission is to become a business owner, a business that manages risk professionally, day in and day out. If you got value from this masterclass, do me a huge favor. Smash that like button, subscribe, and hit the notification bell. It really helps the channel. Now, I want to hear from you. What's your biggest struggle with risk management? Let me know in the comments below. Until next time, trade safe, manage your risk, and I'll see you in the next video.